Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Karl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Krommendyk of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed & Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
We encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast.
Hello, listeners, and welcome back to your Expert Team Network podcast. This is Jeff Krommendyk coming to you from A&I Financial in our conference room here. I'm with Security First Insurance Agency. I take pleasure in managing risk for our clients and clients of our expert team here. I want to go ahead and introduce our team today at A&I Financial. Here is Karl Frank. Welcome, Karl. Thanks for being here.
Thanks, Jeff. It's a pleasure.
Awesome. Hey, Nate Merrill is sitting to my right. Nate is the one of the founding principals of Goodspeed & Merrill.
Thanks.
And,
I'm always to the right, though. So
The way right.
Oh, my. Oh, goodness. All right. And joining us from a distance here today is Mike Miller with Miller and Associates. Mike, thanks for joining us from Austin, Texas.
Thank you. Thanks. Good for being here. And I'm not far right, being that I'm not far away, but a little more right than that.
Well, after we're done talking about what we are going to talk about today, who knows where we'll be, to the right or to the left. I think it'll be to the right, more to the right of each other, but who knows? We'll just see. Little play on words there, but we are going to talk a little bit about the new proposed tax plan, and we're going to actually refer to Karl's most recent Periscope and just kind of hit on a few of the points that Karl brought up in his last Periscope newsletter. So, Karl, I'm going to turn it over to you to kind of tell us where we're headed here.
Yeah, thanks, Jeff. It's great to hear that you guys are looking at it. And it's on the website, assetsandincome.com/blog. And, you know, this act called the American Families Act is a big one. It has not gone through Congress yet, but it did come out of committee. And so they're debating it at this exact moment. And, you know, it starts with some basic things that, from a financial planning standpoint, that I can cover real quick. We lose something called the backdoor Roth conversion, which is something that's a small dollar amount at $6,000 or $7,000 a year that you can make go tax-free regardless of your income. The backdoor Roth, I don't want to get into details on it, but it eliminates that ability to go tax-free, so that's a real bummer. And then it raises income taxes on folks, on single people over $400,000 and families over $450,000. So folks that make a certain amount of money are going to a higher tax bracket, and they go to a much earlier income. That's the other thing that really hurts a lot of folks in that $400,000 range, which in certain parts of America is very middle class. It depends on what, you live in a big city, it depends on what city you live in. That can not, get you nearly as much as it does in the Midwest. But I got to tell you, you hit that income faster, and you're also hit with a higher long-term capital gains tax rate. You go from 20% to 25%, so that's a 25% increase in the actual amount of money you pay in taxes. So that really hurts.
Well, and I believe wasn't it part of it's not captured here, but for incomes over $1 million, it goes up to ordinary income rates.
Oh, it gets huge. Yeah. So,
Yep.
Yeah. What, Mike, you want to pipe in there?
Yeah, Karl, I sent you that example where if you had just looking at the taxation on a $5 million, long-term capital gain under the current structure, today's tax law, you'd be paying combined federal and state about 28.35% in taxes if you live in Colorado. Under the proposed law, a $5 million long-term capital gain would be taxed at 55.48%.
Ouch.
So nearly double the taxation when you're getting into incomes over $1 million in liquidating stock positions and things, or capital assets and things like that. So very painful.
Well, and just to highlight here, it's not only the capital gains rate, but when does that 3.8% kick in? The net investment income tax?
That happens at $5 million, according to the proposal that I saw. So
yeah, I think Carl's correct. However, there are some different nuances with that 3.8% when it comes to pass-through entities, but we won't talk about that one right now.
Yeah, let's cover the pass-through in a minute. That's a huge one because it's a really big deal. If you have your business that you've been working your whole life to build up and you're ready to retire, you're going to go ahead and sell it right now as soon as you possibly can before this deal goes through in hopes that you can get ahead of it. But
no, you're not.
But the problem
if you're not
right?
selling it right now, you're not selling it.
It's too late, right? I mean, the reality is you can't get it done.
Right. But let me.
Well, and if the tax law is correct, it'll be it could be retroactive to like
September.
April.
Yeah. Well, and I think they moved the most recent effective date to like September 18th or something
Which stinks.
But don't anticipate there wouldn't be challenges to that. You said we could get a little bit into the commentary on this, but I do want to bring this particular issue home a little bit because most people would think, wow, someone's making $450,000 a year for them to pay a little bit of capital gains and extra capital gains. That doesn't sound so bad. But you bring up the mom and pop. Like we deal in a lot of SBA level kind of lower tier acquisitions at our firm.
Sure.
This could be people who've spent 30 years building up their business to be worth $2-3 million. It is their entire retirement.
It's everything.
And now we're taxing them as though they are the uber wealthy. Granted, they're not hard off, but these are not your Elon Musks and your.
It's not the Wolf of Wall Street that's paying this tax.
These are mom and pop businesses that have just. It's like your home. You've lived in Denver for the last 30 years. Your house has nearly tripled in value.
Maybe more.
The same thing is true of businesses. They've been working for 30, 40 years building up this business. To them, it's been a livelihood. Now they're selling it, and it's appreciated because the value of the dollar, everything you want to factor into that. And now they're being taxed like the uber wealthy.
It's terrible, isn't it? And that's a huge burden to pay. And it's so unfair to think that if I sold my business September 13th, that I'd pay half the tax that I pay September 14th, right? That I'd pay today. That's just nuts.
Right. Yeah, and so I was using the example of someone who may sell their business for under $1 million. Now you start elevating that above $1 million, and it gets into those
it's huge,
egregious, ordinary, basically taxing it as though it's ordinary income. There's essentially no, under this tax proposal, there's very little incentive to put your capital to work.
Right.
Because that was the whole point of capital gains in the first place, was for people to incent people to put their capital into the markets, to grow the economy, to take that risk of loss. With your labor, there's no risk of loss. You get paid. With your capital, it could go away. And that was the whole point in giving preferential tax rates, was you were taking a capital risk.
And now you've lost that because now your capital is just as much risk as your income as far as taxes. It just, and you add on a state tax on top of that, and oh my gosh, it gets really, really big. Your local taxes are huge.
Yeah, let's just, take this out a little bit. What are the long-term or, macro impacts to the U.S. economy or even the world economy when we're talking about a tax plan like this?
That's a great question. What are the long-term impacts?
Well, yeah, and I'll preface that by saying, we've talked about this before, you and me, Carl, is that these tax proposals generally assume no change in behavior. So they assume that everybody who's making over $400,000 a year is just going to eat the extra 5%. At best, what it's going to do is make people hold on to investments longer, require a higher return before they sell, because now they have an additional 5% hurdle. So it's going to slow down investment in terms of the turns on the market, turns on money. So the velocity of money will slow down. Maybe that's what they want. And secondarily, it could just push everybody into a hold pattern on their capital, and you live off your margin account until they start taxing that.
One of the things that really drives me nuts about it too, because what you read about are the billionaires, right? There's talk lately of the billionaires are going to have to pay
Their fair share.
Their fair share, which means income tax on their unrealized capital gains. And so, we look at that and we think, well, there's how many 100 billionaires in the whole country, right? It's a really small number. It's a ridiculous conversation to even have where we're worried about them or even talking about them. It's taxes like this that aren't getting the attention that they need to, because just like you said, people have put their capital at risk. They've grown it. They've built a nice place.
If I can, this isn't actually conspiracy theory. This is reality, and this is something that I'm sure annoys politicians to no end. Those billionaires can move. They can buy their own island. They can move to Puerto Rico, and in Puerto Rico, they're under a totally different tax regime until they change that. But under the Puerto Rican law, and this isn't going to apply to a lot of our listeners, except for it should inform them as to why you don't hear billionaires lashing out at this tax plan, is they will move to a lower tax jurisdiction. They absolutely will. They already are. I can tell you that from some of the work I'm doing is the uber wealthy are already building out Puerto Rico. They're already moving to other countries where this will not apply to them.
Crazy.
How do you can't, anyway.
Mike, what do you think about all that?
That'll just stifle investment, which will lead to job loss, which will lead to economic downturn, which will lead to higher inflation, et cetera, et cetera. I just don't understand what the purpose is behind their thinking. And I don't know if you guys saw the one tidbit of Biden's request in that last infrastructure bill. He wants to monitor every transaction in everybody's bank account that's $600 or more.
Mm-hmm.
They want access to that. Like, why? Why do they want to track 600? What's the purpose?
Yeah, and I saw as of yesterday they raised it to 10,000, but still, and they're trying to send it to the IRS, right? So that they don't have illegal, tax avoidance. Holy cow! I mean,
$78 billion to fund the IRS.
It's amazing.
$78 billion to fund additional IRS activities.
And to only focus on the rich.
Yeah,
that's a lot.
I got a bridge to sell you, if that's the way it plays out. But yeah, I think Mike and I are both on the same view in terms of what this means for those who are under that 400,000. Life goes. I mean, this is where they have, I guess, maintained some truth to their promises. Is that if you're not the rich, again, it's just. I remember. Right. I'm going to go back to 2001, 2000, when Bush was in office and was addressing the estate tax. Back then, the estate tax exemption was $600,000, right? And what had happened, and this is the same thing we're facing down now because of so much influx of capital markets, but back then they were using as kind of the hard luck cases to make the case that the exemption needed to be increased is these teachers in Seattle who had bought their house back in 1955, and now their real estate had appreciated.
How do you still remember this? What a great story.
But they were living on a pension. They were fixed income folks living on a pension, and the estate tax was hitting these individuals. They weren't by any stretch rich,
not at all.
And so that it got everybody on board that we need to start raising the estate tax exemption.
And you know what happened? It made a lot of attorneys rich because you guys wrote a whole lot of really complicated estate planning trusts with AB, Merrill trusts, and all that type of stuff. A lot of life insurance sales. I remember helping an educator here in Colorado with, $750,000, not a broke educator, but he had all this complicated stuff going on that he didn't need anymore. And oh my gosh, we had to unwind all this really complicated stuff, right? And it was a nightmare. But you're right, that's going to start inciting really strange behavior. Like, okay, I make $410,000 right now. How can you get me $20,000 less income, Mike? You know what I'm saying? You're going to start getting really weird behavior.
Or people will just stop making money. I mean, it's a diminishing return thing. It's you start taxing progressively more. It's going to prevent productivity.
Yeah, you get less of what you tax. Hey, let's talk.
And why would people with all the money want to invest in anything here with that kind of tax structure.
Right.
I just don't see investment opportunities going through the roof here.
I know it. It hurts. It hurts. It's a world market, and money will flow where the tax rates are lower, and where things are safer. Let's talk about some of the things that affect business owners in particular. I know this is one that's near and dear to Jeff. We've got to find a way to help business owners like Jeff. What is going on with the business owner tax structure? Holy cow. Mike?
I'll give you something to work with, Mike. It's not so much tax here as it is insolvency of our entitlement programs. Go with that, Mike.
Thanks, Nate. We've kind of created a situation, and we're trying to, $6 trillion shell out by the government and looking at another 3.8 trillion in this next package. I mean, something's got to give, right? And you and Nate, you and I had this conversation, right? It's either some of those programs have to go away, or we have to raise taxes, or we have to print new money, right? One of those three things.
Right. One of the things I was getting at in particular was they keep adding this 3.8% onto anything they can.
Yeah, it's a really tricky way to do it. So your marginal income tax rate, caps out at 38 point something, but then business owners have to pay another 3.8 surtax on top of it. So Jeff, I'm sorry, my friend, as an S-corp business owner, if you make too much money and you're profitable and you're over these numbers that we just talked about here, you're going to pay another 3.8 on top of what an employee who has the same salary and bonus would have to pay. How does that make you feel?
Yeah.
Well, it's an inference that every dollar you make is wages. So it's moving everybody into the labor category. There's no such thing as being a business owner again under these structures, because they're basically nailing you with all the employment tax for.
I'd rather be an employee.
Earning on capital, earning on sweat equity, earning on whatever. Every business owner knows that you don't make your compensation. Like the money you take out of your business is not you sitting at your desk working 40 hours a week, whether people like that or not. But now they're basically treating that every dollar coming out of that business if you're over 400,000 individual, 500,000 married, they're treating it essentially as wages.
Can you talk a little bit about some of the things that business owners lose in here? And you and I were talking, well, all four of us were talking just before the podcast, but share some of that really bad news.
Well, again, most of this applies to the over 400, over 500 category. So they're
the successful.
They're keeping their electoral block in place. The literally 47, 53. It depends on what stats you look at. That don't net contribute to the federal coffers. That get a net benefit from the federal government versus what they pay in. So they're keeping that voting block in place. It's basically the top 47%, which pay most, if not all, of the federal income tax that we're talking about here. They're just fleecing them a little bit more. So one of the big ones that I think was largely responsible for contributing to economic growth over the last 4 years was this 199 Cap A, the qualified business income deduction. For a company that had proper metrics, and I won't get into what those metrics are. You can go back to those earlier podcasts. You were eligible to deduct 20% of your income when you filed your taxes. And the incentive was to increase payroll. The incentive was to increase investment in your business. And so there was a definite advantage afforded businesses that were investing and growing. And that will now go away for any business over $400,000. So you have no incentive anymore, 400, 500, to do that additional growth. So that they've just taken away all those business investment incentives. Again, assuming behavior is not going to change, that people will continue to invest the same way and get less returns and be happy with that.
Yeah, you'd choose a different route, wouldn't you? Right? Of course your behavior is going to change. That's always what taxes do. They change behavior.
Yeah, so we've been talking a lot about S corporations here. For other business structures, will it be LLCs, I think, are probably treated similarly, passed through. But are we seeing some things emerge here, Nate, if this does go through and you're the you're the business structure guy. I don't know anybody better in the business than somebody who like yourself. But are there other structures that we as business owners need to be potentially thinking about if this thing passes?
Yeah, that gets really difficult. Mike, what do you think? I mean, I know C Corps, right? Do you know what the tax on C Corps is going up too, isn't it, Mike?
Yeah, they're proposing they initially proposed 28% flat rate, and now they're proposing 21%, with some income caveats, I believe. Lower tier might be a little bit lower, but 25%. And again, you're looking at double taxation of the C Corp, right? Because you're paying 25% plus state tax on whatever the C Corp's earnings are, and then you're taking dividends out of the business.
So what
and
are
you're
people
rolling
gonna
those
do?
over onto your personal return and paying taxes on them again.
Right, that's not what you want to do. So what are people going to do? How are we going to, if this were to go through, what types of steps should we be taking now?
Well, again, true to their word, they haven't left much in the way of planning loopholes, at least, again, above that $500,000. There's still some of my more advanced structures like captive insurance that we've talked about that are still going to be valid for business owners to do what I call earnings stripping. You can still do some of that earnings stripping through creative structuring. So C Corps might be the haven for tax efficiency on retained earnings with that one caveat. As Mike pointed out, they are proposing raising the effective rate for corporations, but moving to a C Corp from these flow-through entities might be a transitory business haven.
How ironic is that?
Well, I don't think it's without intention, though, because, again, I go back to what I said. Some of this is driven by a desire to fund the entitlement programs. They can't just, as a factual matter, they can't just print money and put it into Social Security. They can't print money and put it into Medicare. These have to be funded from withholdings from compensation. So they're doing what they can to basically either treat business earnings as compensation, like we just talked about, with these flow-through entities. Once it gets above a certain point, they'll tack on that 3.8% and fund Medicare and the ACA that way. With moving people into corporate structures, one of the ways you avoid the corporate double tax is to pay more in wages. So they are just driving you into environments that are wage equivalent. Like I said, they're either going to treat your flow-through income as wages, or they're going to force you into a C Corp and force you to pay wages to get out of the double tax. And all that extra money goes into the trust fund.
Ouch.
Yeah, they're not leaving any big planning opportunities out there if this all goes through. There's not a lot we're going to be able to do.
It's just not a hopeful tax environment. I mean, really, if your mindset is such that the government is the best steward of money, this is a dream. This will accomplish that. And ironically, I don't think it will raise as much as they say it does. They'll still spend at the low end of the estimate, $3.5 trillion. Everybody talks about that one. Other end of the estimate is $5 to $6 trillion is the actual cost. Add into the fact that they're just projecting costs over 10 years. Most of these programs will never go away, so they'll exist into perpetuity. So we're really talking about infinite trillions of dollars. But you need growth to actually generate revenue, absent the other thing you and I have talked about, which is just print and borrow, print and borrow, print and borrow. So there's the modern monetary theory discussion we could have in terms of, is this even problematic?
Another podcast awaits. Any parting thoughts, guys?
Yeah, just one thing, Carl. As I look at the podcast, the Periscope here, we talk a little bit about that family $5 million estate tax exemption going down from 11.4, which equivalently on a married couple is probably closer to 22 million. Is that correct?
Right.
And 23.4 right now.
So that's a big deal. I mean, I don't know. I mean, it doesn't take much of an estate anymore to get to 5 million.
Isn't that amazing? Right? And you can be very middle class and have that many assets just between your real estate and if you're a business owner and if you have an inheritance that you might get someday. I mean, your parents' house or other relatives' house could, before you know it, you're there. And the estate tax is a 40% tax.
Well, not only that, they want to disincent you to do any planning. Again, most of what we do in wealth transfer planning is moving assets out of the estate now and letting them grow estate tax free. So you're transferring them into a trust that won't be taxed at your death. Now they're basically going to treat that as a transaction, a taxable transaction, to collect revenues on it. It's partially to disincent you from doing that kind of planning so that you just hold your assets and die with them.
That is a great explanation for a really complicated topic. Thank you for simplifying it because, that's the bummer right there.
My parting thought would be I don't expect a majority of this to actually make it into law. So if there's a silver lining that I can offer everybody in my angst as we've talked about this, it's that the dynamics in Congress right now should yield very little on this front. But it is a very dramatic attack on the American capitalist system to even offer it up as a possibility, in my view.
Yep, pretty bold. Well, this has been amazing. I mean, it's been great just to sit back and listen to you three guys really dissect this. I mean, it's fantastic. It's a lot of I think speculation at this point in time. So, Nate, I do appreciate your final thoughts, and I'm going to rest a little bit better tonight, knowing that is probably the reality. But nonetheless, great conversation. I want to thank you guys. We're going to sign off for now, and thank you, listeners, for listening to your expert team. And we look forward to catching up with you next time. Thanks.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
You want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through ANI Financial Services, and securities may be provided through Genios Wealth Management.